Let's talk some more about the effect of an external market on the optimal transfer price within the firm. Suppose there is a perfect intermediate market. That is, the buyer can buy as many units as they need externally without affecting the market price, and the seller can sell as many units as it can produce externally without affecting the market price. That means that both the buyer and the seller are price takers. In other words, the market set the price. So how does that affect the optimal transfer price? It means that the best transfer price is going to be the intermediate market price. It has to be, because if the transfer price were any lower, then the seller will not supply the component internally. They will choose to sell all of the units that they make externally. On the other hand, if the transfer price is any higher than the intermediate market price, then the buyer will not buy the components internally. They will choose to buy them externally. Because of that, if the transfer price is set at the intermediate market price, then each manager will choose to do exactly what the firm would want them to do. That is, set the transfer price at the external market price, and then the seller division will provide the units that the buyer division needs. What if there is no intermediate market either, because one doesn't exist? The components are so specialized that they can only be produced internally, or if the firm says you're not allowed to buy externally or sell externally. Let's look at some possibilities. What if the transfer price is set at less than the seller's variable cost? In that case, the selling division is going to lose money on each transfer, and that is going to serve as a disincentive for the seller division to provide units to the buyer division. The more they provide, the worse they look. What if the transfer price is set at the external final market price minus the buyer's variable cost? No transfers will take place. What if the transfer price is set at some amount that is bigger than the final external market price minus the buyer's variable cost? In that case, the buyer is going to lose money on each transfer, and that serves as a disincentive for them to accept those transfers. No transfer will take place. Therefore, the optimal transfer price in this scenario is going to be the seller's variable cost if the seller division is operating at below capacity. The reason for this is that the seller's fixed costs are unavoidable, and as we discussed in a previous chapter, unavoidable costs are not relevant for current decisions because they are going to be there no matter what decision is made. Let's take a look at the example for XYZ. It's the same fact pattern we used originally in the previous section. The seller has excess capacity. The variable cost is $20 per unit in the seller's division. The buyer must add an additional $45 of work, and the finished product can be sold for $100 externally. There is no intermediate market for the component. Therefore, From the seller's point of view, any transfer price that covers its $20 variable cost or more is acceptable. Of course, we know the fixed costs are irrelevant because they are going to be there regardless of what the transfer price is. From the buyer's point of view, the transfer price can be any amount less than the difference between the $100 external selling price and the division's own $45 of cost. That means that the transfer price would have to be less than or equal to $55. So where do these two ranges intersect? They intersect at a transfer price that is greater than or equal to the seller division's $20 variable costs and less than or equal to the buyer division's $55 gross profit. Now, what about the firm? For the firm, the costs incurred include the $20 seller's cost and the $45 buyer's cost. So, as long as the selling price in the final market is greater than $65, then the product is profitable and the firm would want the transfer to take place. Therefore, the firm needs to pick a transfer price that would incentivize the seller providing the component and the buyer using the component. At a $65 selling price, the firm doesn't care. It's not making any profit on the deal, but it's not incurring any loss either. At a selling price below $65, the firm would not want the transfer to take place. So, what's the right transfer price? It's going to be the seller's variable cost because that is going to incentivize the transfer over the widest range of external selling prices. That would be any price over the total cost of $65. Let's look at a practice problem. Acme Widgets sells its product for $15 per unit. Division A makes a component that is used by Division B and has a variable cost of $2 per unit. Division B adds another $5 of additional cost per unit. So, my question to you is, what is Acme's profit per unit? Here, Acme's profit per unit is the difference between the $15 selling price and the $7 of cost, $2 from Division A and $5 from Division B. In other words, Acme's profit is $8 per unit. Now, if Division A has excess capacity, in other words, it is not fully busy doing other things, and there is no intermediate market, what is the optimal transfer price? Let's think about it. For Division A, the transfer price should cover its variable costs and could be any amount above that $2 per unit. Because Division A has excess capacity, that means that its fixed costs are not relevant for this decision. For Division B, the transfer price has to be sufficiently small that it will allow that division not to operate at a loss. It would operate at a loss if the transfer price was $8, because then it would be giving up all of its profit. So for the firm, the optimal transfer price would be Division A's $2 per unit variable cost, because that will incentivize Division B to continue acquiring the component, producing the final product, and selling it externally over the widest range of external selling prices. In other words, if the market price for the final product drops below $15 per unit, B will still make it and sell it externally, which will be profitable for the firm. Let's look at another practice problem. We have a company, Keep 'em Flowing, and it has two divisions. The motor division manufactures motors that it can either sell externally or it can transfer to the pump division. It has variable costs of $12 per motor, and that gives the division a contribution margin of $8 per unit. The pump division makes water pumps that it sells externally, and it needs 10,000 of these motors every year. The water pumps sell externally for $80 per unit, and their variable costs other than the motor are $30 per unit, and if they did not buy their motors from the motor division but bought them externally, it would cost them $19 per unit, giving them a contribution margin of $31 per unit. So, in the first scenario, the motor division can sell its units externally, and it is operating at capacity. That means that it is fully busy selling its motors externally. What does that mean for the optimal transfer price? The motor division has no excess capacity. That means there is an opportunity cost of transferring motors internally. In other words, the motor division has to give up an external sale and the profit that would come from that sale if it transfers any motors to the pump division. In this particular case, their outlay cost is $12 per unit plus an additional $8 of contribution margin that is lost every single time the motor division makes a motor and transfers it to the pump division instead of selling it externally. Therefore, the transfer price has to be the $20 external market price. If the transfer price is any less than that, the motor division simply won't transfer any motors to the pump division. It will sell them all externally. What about the pump division? It can buy motors externally for $19 each. Therefore, in this particular scenario, no internal transfers should take place because the motor division can sell externally for $20 and the pump division can buy externally for $19. So no transfer should take place because it's not in the best interest of the firm. Let's investigate this situation a little more. Supposing the firm chose a $12 transfer price, that is the motor division's variable cost, instead of the $20 external selling price. How would that affect firm profits? Well, for the motor division, that means that they are going to lose their $8 contribution margin for every single motor that they provide to the pump division. For the pump division, they're going to save the difference between the transfer price and the external selling price. The external price is $19. The transfer price is $12. They're delighted to save $7 per pump transferred. But from the firm's point of view, that means that while they're saving $7 in the pump division, they're losing $8 in the motor division. Net, they will lose $1 per internal transfer because they chose the wrong transfer price. Let's look at a slightly different scenario. What if the motor division has excess capacity? It can make more motors than it currently sells externally. What should happen now? Well, since the motor division has excess capacity, that means there is no opportunity cost. They're not losing the contribution margin on an external sale by making an internal transfer. Because of that, any transfer price that covers their $12 variable cost or more would be acceptable. For the pump division, they have to pay $19 externally to buy from an outside supplier. As a result, the optimal transfer price should be somewhere within this range, at least $12, not more than $19, because that will benefit both divisions. So, what is the correct transfer price? If the firm chooses the $12 variable cost to the motor division, what happens? The motor division is going to experience no opportunity cost, but the transfer price is just going to cover its variable costs. Therefore, it would recognize no profit and no loss on the internal transfers. The pump division is going to save $7 on each internal transfer because it can buy internally for $12 instead of externally for $19. Net, the firm would save $7 per unit. Let's look at another possibility. Supposing that the motor division is operating at capacity, it is fully busy with its external sales, but the pump division needs a special motor that cannot be purchased externally. Only the motor division can supply it, and its variable cost is $22. Let's look at this scenario for the motor division. Its internal cost is going to be what it expends in variable costs plus the fact that it has an opportunity cost, because every motor that is provided to the pump division means that's a motor that is not sold externally. So the variable cost is $22. The opportunity cost is the $8 contribution margin that is lost when a sale is not made externally. Net, that means that it costs the motor division $30 to provide a motor to the pump division. Therefore, the motor division will not make an internal transfer for less than $30. The manager would prefer to sell the motors externally. What about the pump division? They can't buy the motors externally. Therefore, if they need the motors to produce their pumps, they have to accept the $30 transfer price. Let's look at another scenario. What if we have the same set of facts? That is, the pump division needs special motors that have a variable cost of $22, but the motor division is operating below capacity. In this case, there is no opportunity cost because the motor division is not fully busy making external sales. Therefore, its minimum transfer price would be its variable cost of $22. The pump division has to get its motors from the motor division, so it would be willing to pay any price from the $22 variable cost up to the combination of the variable cost plus the $8 normal markup, so they would pay anywhere between $22 and $30. And that would be a matter for negotiation between the two managers. As the transfer price gets closer to $22, it gives the profit advantage to the pump division. As the transfer price gets closer to $30, it gives the profit advantage to the motor division. So how do we choose a transfer price? There are several ways. One possibility is for top management to decide, this is the way we're going to do this. And this method is used primarily if transfers are very large and if they are very rare. However, this method has some issues because it may mean the top management is constantly having to deal with dissatisfied divisional managers. In addition, it takes away some of the divisional managers' flexibility and sense that they have control over their division. Another method would be to establish firm-wide transfer price policies. There are several possibilities. Market-based transfer prices are usually set at just below the external market price, and this would be used if the firm really doesn't care whether the component is acquired internally or externally. Alternatively, the policy could be to use cost-based transfer prices. In that case, the cost-based transfer price should be at the standard cost, not at the actual cost to produce the component, because using actual cost would not incentivize the seller division to be efficient. So, if cost-based transfer prices are used and the seller is below capacity, we've already seen the transfer price should be the variable cost because there is no opportunity cost, there is no lost external sale. If the seller is at capacity, however, then the transfer price should be full absorption cost. In other words, the external sale would help to cover the division's fixed costs, and if that external sale is not made, then the buyer division must cover those overhead costs. So, the seller division is really a cost center if most of its transfers are made internally rather than externally. The third policy option would be to use cost plus transfer pricing. In other words, share the benefit between the buying division and the selling division. The third possibility for a transfer pricing policy would be to use cost plus transfer pricing. Exactly how much is added onto the cost depends on the firm's established policy, but in any case, this policy shares the benefit between the seller division and the buyer division. The third option is to allow the two managers, the manager of the buying division and the manager of the selling division, to negotiate a transfer price that treats the managers as if they run independent firms and are negotiating a contract. In that case, the negotiated transfer price must at least cover the variable costs of the selling division and certainly can't be greater than any external market price. The good point about using negotiated transfer prices is it respects the decision-making ability of the divisional managers and it keeps top management out of it. However, there are disadvantages. Number one, negotiating a transfer price takes time and effort, so the firm should think about whether the benefit derived from a negotiated transfer price is worth that cost. In addition, negotiation takes personal skills. If a firm chooses negotiated transfer price, the agreed upon price will probably favor the manager with stronger negotiation skills, and the firm has to decide if that is what it wants. The last issue in this section is segment reporting. As we know, GAAP requires firms that have different business segments to report on the profitability of those segments in order to allow external decision makers to decide how much each segment contributes to overall firm profitability. While we will not see the effects of transfer pricing on the overall financial statements, they will affect the segment reporting because GAAP requires firms that report on business segments to use the same accounting policies externally that they use internally for decision making. Therefore, using transfer pricing and choosing a particular transfer price will affect the amount of income that is reported for different business segments.